Before we start this video, do like and subscribe to our channel and not miss on any updates.
This chapter on internal reconstruction is only based on logics. There is nothing, extraordinary in this chapter. There is nothing that you need to remember in this chapter. It is purely based on logic. Right? Now, what is the logic? Typically, what happens is in a question which is based on your internal reconstruction, you will be given balance sheet of a company with some assets, with some liabilities, some equity component, and generally losses. Okay. A company which is suffering losses, which has made losses, right? So generally this is the category of balance sheet that will be given. And the question of reconstruction basically means we are reconstructing. See, construction is fresh construction. We are building a company of fresh. When we say reconstruction, it is basically our house has become old. There are some problems in the house. There are some seepage issues. There are some other issues. So what do? We try to do some kind of reconstruction activity. We try to break down something, add new things. That is what is called reconstruction. Of course, this has to be approved by the court of law. It has to be agreed upon by the creditors, by the shareholders. All of that is the legal part. Okay. Now, in our examination, we are bothered about what do we do with this balance sheet which has to be reconstructed. Okay. Now, typically, when you see reconstruction of a balance sheet and when there are losses in the company, what generally tends to happen is if the company is continuously incurring losses, it will not be able to continue for a long period of time. So if the company is not able to continue, the liability holders, that is your loans who have given you loans, your creditors and all of these, they will not be able to recover the money. So what do is they come and they agree for some sort of a compromise or arrangement. So basically what they will say is, okay, let's say for example, loans outstanding is 1,000. The company says, I don't have money to pay 1,000. If you keep on asking me money, if you keep on asking me repayment of loan, I will not be able to repay. I'll close my business. I will file for bankruptcy and I'll say, I don't have money. Do whatever you have to do. Now, this is not the right thing both for the lenders and also for the company. See, someone who has given the company a loan, they want to recover some amount. If they keep on saying, pay me now, company may not be able to pay. So these people will lose out. Same way, equity holders will also lose out and the company will not be able to continue. Right? So in the arrangement, what happens is these liability holders, they come up and they say, okay, we'll forgive some part of the loan. We will give you some more time to repay the loan. Convert our loan into equity shares. Do something so that our interests are also protected and you have some breathing space. You have some time to continue the business. You have some time to reorganize the business. Subsequently, when you make profit, you will be beneficial. For example, instead of loan, the person may say, okay, I will forgive 250 of loan. This is forgiven. I forgive 250 of loan. Means don't pay 250 of loans to me out of 1,000. Then, out of the remaining 750, give me equity shares of 250 and balance 500 will continue as loan. All past interest, whatever is there, I don't want. Now, in these kind of arrangement, what is happening is the creditor or the lenders, they are bearing some loss. They are also taking some equity so that in future, when the company does really good, they can make profit and some part of it continues as loan. Okay. Now, think of a scenario. If these liability holders, the lenders and the creditors, if they are giving up something, they will also want the owners, the equity shareholders, the preference shareholders to give up something. So each party who has to receive some money from the business, they will give up something. Right? And then after the arrangement, what happens is then they will continue. The business will continue in the hope that in the future we will make some profit and we will be able to repay this. Right? That is on the liability side. On the asset side, what happens is there would be some assets which do not have the value that is shown in the books. So we will bring down to their realizable value. Then there are some assets which the company may not need, which are not core assets for the business. For example, let us say we talk about something like a investment. The company is already into so much of losses, so much of problem. So the company says, okay, I don't need this investment. Let me sell off this investment. I will get some money. With that money, I can maybe settle some liabilities, or I can use that money for my subsequent working capital purpose. Okay, this is the whole scenario where a reconstruction happens. That is the first part. Now, how do we account for it? That is what is more important, right? They have given us balance sheet. In the balance sheet, we have assets, we have liabilities, we have equity, we have losses. How do we account for it? What is the accounting treatment to be done? Now, the only rule that you need to remember is, if there is a gain because of an adjustment, I'll open one account called capital reduction account. If there is any gain means either my assets have gone up or my liabilities have come down. Assets going up means what? Debit assets. Liabilities going down means what? Debit liabilities. So either there is an increase in asset or there is a decrease in liability. Whenever this scenario arises, if my asset value increases, I gain. If my liability value decreases, I gain. So I will credit capital reduction account. So any increase in asset, increase in asset, or by liability decrease in asset, we will prepare an account called capital reduction account. This similar to what you do as a revaluation account in partnership. You would have done, all of you would have done, right? Revaluation account, same thing what we are doing here. Okay, nothing new. Then, if there is a decrease in asset, if there is a decrease in asset, or if there is an increase in liability, that is a loss. So all my losses will come here, all my gains will come. Same way, equity generally will be loss only, gain only, because equity holders have to sacrifice something. So if there is any gain means what? Equity value we have reduced. So here you will say by equity, this is a reduction in value of equity. That results in gain. Then there may be some fictitious assets which may no longer be required. We have to write off. It's a loss. So to fictitious asset, not fixed asset, fictitious asset, it is a reduction. Okay. What to do with losses and all will come based on each type of questions we'll handle. But generally the scenario under capital reduction account is, any gain I will credit, any loss I will debit. Now in the examination, the question requires you to pass journal entry. That is what is the question. When they ask you to pass journal entry, typically you also need to prepare cash book or bank book and capital reduction account. These two ledgers you have to prepare generally. Even if the question doesn't ask, in your interest, you have to prepare these ledgers. Alright, so we will prepare capital reduction and we will prepare cash and bank book. Now, a lot of you generally face this problem of, while passing journal entries, we may tend to forget whether to debit, whether to credit, whether to increase, whether to decrease. It can be a confusion. So for that, what you can do is, on a safer side, you can start looking at capital reduction account for practice purpose. Start posting in capital reduction account first and then pass the journal entry. That will help you. For example, increase in value of asset. You will say by fixed asset. When you post it here, what is the journal entry? Fixed asset to capital reduction. So that way you can do. Okay. Now, some of you have this doubt. So do we pass combined entry, single entry? Depending on your comfort. Okay. All assets revaluation, you can pass a single entry. All liabilities revaluation, you can pass a single entry. Then we will see special cases like asset is taken over, liabilities are taken over, something like that. There we have to pass and one by one. Okay. So far, do you have any question in all of these discussions that we had? Any question, any doubt? Please let me know. Otherwise, we will continue to the next part. Okay. Now, the next thing that comes is for equity. Now, as far as equity is concerned, typically what happens is, generally most of the questions, one, there is a reduction in face value. For example, original face value is 10, new face value is 2. Number doesn't change. Number doesn't change. Face value changes. What does that mean? Earlier, the company said we had to pay a 10. Of course, only when you have money you will pay 10 to the equity holders. Now we are saying we will pay only 2. So, equity has reduced. By what amount? By 8. This 8 becomes my gain. So, what will I do is, I will say equity face value 10, debit 10, 2 equity face value 2, credit 2, 2 capital reduction 8. This is my gain. Sometimes the question doesn't talk about reduction in face value, the question talks about split. Now when there is a split in shares, there the total value does not change, only the number of shares changes. So in case of split account, splitting, it is only equity face value 10, debit 10, 2 equity face value 2, 10. So here it is 1 share of 10 rupee which has become now 5 share of 2 rupee. Here there is no gain or loss. This generally doesn't happen. Most of the time this is the scenario that you will see in the examination, right? Then the balance that is left over in capital reduction account, this is a gain. This gain will be used to write off assets as given in the question. All fictitious assets must be written off, but other assets only if the question asks, then only you have to write off. Then you will use it to write off losses. If any balance left, balance will be transferred to capital reserve. Balance will be transferred to capital reserve. Then you will be required to prepare sometimes balance sheet after reconstruction. There what you have to do is assets plus or minus based on this capital reduction account. Same way liabilities plus or minus, equity plus or minus, losses, whatever was there will not be plus, of course there will be minus, capital reserve if at all there is a balance. Okay, this is how the flow works. Now the best way to do this chapter is to take up questions, and we'll take up examination questions to see what are the things we should keep in mind and where are the mistakes that students normally tend to do. That is the first thing. And second thing is how to read the adjustment. See, this question is all about understanding the English in the adjustment. If you are able to do that, most of the problem in this chapter is absolutely solved. Okay, so let us go to the questions. 14 marks question in May 24. Following is the summarized balance sheet of Z Limited on 31st March of 24. You have share capital, equity shares of 100 each. Now here numbers are very important because they will say 100 became 50, 100 became 20. You have to read carefully. 8% preference shares of 100 each and 10% debentures of 100 each. So we have equity, preference, debentures. Trade payables, so much. So very carefully you have to read the balance. Amount you can leave it, but these balances you have to read very, very carefully. Goodwill, 81,000. Property, plant and equipment, 72. Trade receivables, 1375. Inventories, 980. Cash at bank, 133. Owned debentures, nominal value of 6 lakh, 576. Owned debentures means you have purchased your own debentures, which is there in the balance sheet. Profit and loss account, 1235. This is a debit balance. Okay, so these are the numbers. Now, on 1st April, court approved the following reconstruction scheme for Z Limited. This balance sheet as on 31st of March. On 1st of April, the court has approved. Okay. What is the approval? Equity shares shall be subdivided into 10 equity shares of rupees 10 each, fully paid up. After subdivision, equity share capital will be reduced by 40%. So now, the key to solve this is to understand each adjustment properly and pass the necessary entries simultaneously. Okay, simultaneously you have to pass the entries. Only then you will be able to solve these questions on time and you will not miss out on anything. Okay. What does first thing say? Each equity share shall be subdivided into 10 shares of 10 each. What do we have currently? 1 share of 100 each will now become 10 share of 10 each. Is there any gain or loss? There is no gain or loss. So in the first entry, when we are subdividing equity shares, there is no gain or loss. So simply what you will do, you will say equity share capital old face value rupees 100, debit 60 lakhs. Where do I get this 60 lakhs? This full value. Then 2 equity share capital rupees 10, 60 lakhs. 100 became 10, total value did not change. Total value did not change. This is called splitting of share. First thing you have to keep in mind. Okay, then after subdivision, equity share capital will be reduced by 40%. Now here the problem is, or confusion is, to by 40% means if it was 100, I will reduce by 40%, I'll bring it down to 60. If it is 240%, it was 100, I am bringing it down to 40. Difference is there. Okay, so here we are saying by 40% means what? 60 lakhs whatever is there, of this 40% is as if we are cancelling them out, or as if we are writing them off. If I am reducing equity, tell me whether it will be gain or a loss. It will be a gain, right? So how much gain? 60 into 40%, 24 lakhs. 60 lakhs into 40%. Equity share capital account debit rupees 10. So this is important here. Rupees 10 it has become to capital reduction account 24 lakhs. Sir, we get confused when we pass journal entries. You can prepare the capital reduction account and write here by equity share capital 24 lakhs. By equity share capital 24 lakhs. Okay, then when you prepare the balance sheet, what will happen? From this 60 lakhs, you have to do minus 24 lakhs because 24 lakhs has been returned. Preference shares dividends are in arrear for last 4 years. Preference shareholders agreed to waive 75% of the dividend and accept payment for the balance. What are they saying? How much it is outstanding? There it is outstanding for 4 years. What is the rate of dividend? 8%. Okay. So what do you have to do? Now for this, you can prepare a working note because that will help you calculate easily. Or while passing the journal entry itself, you can show the note. Okay. What is the amount? 8%. Preference shares of 100 each, 21 lakhs. So dividend is equal to 21 lakhs into 8% into how much? 4 years. 4 years it is outstanding. What have they said? They have said that 75% of the dividend claim they have waived off. Okay. Now, first thing, is this dividend recorded somewhere here in the balance sheet? It is not recorded. It is not recorded. If it is not recorded, then whatever has been given up or whatever has been foregone, whatever is the gain is irrelevant for us. Because the dividend payable liability is not recorded. A liability which is not recorded, even if somebody says I don't want that money, it does not impact my balance sheet. Okay, so first thing is the 75%, because it is not recorded, I don't need to worry about it. What do I need to worry about is balance payment they have accepted for 25%. Payment means what? Have they given up? No. They want money. How much? 25%. So into 25% if I do, this becomes 25% into 4, again becomes 100, and 21 lakhs into 8%. So 21, 1, 2, 3, 1, 2 into 8%, 1,68,000. 1,68,000 into 25 into 4 if I do is 100. So 1,68,000 is what I need to pay. Now is this liability recorded? No. If liability was recorded, I would have said dividend payable to bank. But now dividend payable is not there. The liability is not there, but I still have to pay. If I'm paying, money is going out and it is a kind of a loss for me because I'm paying extra which is not recorded. So 1,68,000 becomes my loss, which will be debited to capital reduction account. So capital reduction account to bank account 168. Simultaneously post here to bank, you can write in the brackets dividend 160. Okay, are we clear how to break down? Can we pass combined entry for first two? You should not, because the question has said first we have split and then we have reduced. It is not split and reduction together. First split, then reduce. So pass two separate entries. By saving one line, you will not save you will not save much of time. So better to do it separately. Then owned debentures of rupees 2,40,000 nominal value were sold at 98 cum interest and remaining owned debentures were so owned debentures of rupees 2,40,000 nominal value. How much is the total nominal value? 6 lakhs, right? So what happens is, the way it works is, or I'll show a separate working note, that will be easier. 2,40,000 nominal value. What is the total nominal value? 6 lakhs. For 6 lakhs nominal value, cost is 576. I need to know what is the cost for 2,40,000. How much? I can do a simple cross multiplication. That is 2,40,000 into 576 divided by 600. What will this give me? This will give me cost of own debentures which has been sold. So, how much is that? 2,40,000 multiplied by 576 divided by 6 lakhs, 230,400. 2,30,400 is the own debenture which is sold. The cost which is sold. Sold for how much? Was sold at 98. Sold at 98 means 98% of 2,40,000. So 98% of 2,40,000 if I do, it comes to 235,200. 235,200. Sir, what about this cum interest? See, balance sheet we have prepared as on 31st of March. Okay, as on 31st March, debenture interest would have been paid. On 1st of April, we are selling. There is no information of what is the interest accrued and all of that. So, ignore this part. Simply take 98 to 2,40,000. You get 235,200. What is the cost? 230. Sale value 235. When I sell an investment, I will say bank debit to own debenture, to own debenture, to profit. Profit will go to capital reduction. Okay. Come interest, X interest, some more discussion we'll have when we do accounting standard 30, no need to worry about that. So what is the gain? 4,800. This is recorded. Now in capital reduction account, how will the entry be passed? You will just take this capital reduction. You can say by bank 4,800. By bank profit on sale 4,800. Okay. Then debenture holders of rupees 6 lakhs agreed to accept one machinery of book value 9 lakhs in full settlement. What does that mean? Out of whatever machinery we have 72 lakhs worth of machinery. Debenture holder says, you give me 9 lakhs of machinery and whatever is the debenture out of this 18 lakhs, 6 lakhs, we will say we don't want it. We have 6 lakhs of debentures that you need to pay us. Give us machinery of 9 lakhs and we will go away. Now what is happening? Liability we are reducing by 6 lakhs. Asset we have to reduce by 9 lakhs. It is like I have to pay somebody 6 lakhs. I am paying that person 9 lakhs. Means what I am paying extra. Maybe the book value, the realizable value of this may be lower. But 6 lakhs of liability I am settling by paying 9 lakhs of asset. So asset has gone down by 9 lakhs. So what you will do? You will say, when asset goes down by 9 lakh, you will say to asset or you will credit 9 lakh. Here you will debit only 6 lakh. Debenture liability will debit only 6 lakh. Where will I debit the balance 3 lakhs? The balance 3 lakhs will be debited to your capital reduction, which is a loss. So the way it works is 10% debentures 6 lakhs, the liability reduction. Machinery or PPE 9 lakhs, that is what I have transferred. 3 lakhs is the loss. So when you are preparing the balance sheet, 6 lakhs will go off from your 10% debentures account and machinery or PPE 9 lakhs will reduce. Balance 3 lakhs will be to the capital reduction. In capital reduction, you will write to PPE 3 lakhs. Now you may have a doubt, sir, how do we know whether we need to write 2 or what? See, capital reduction is debit. Debit is 3 lakhs. 2 or 2 machinery or PPE. Are we clear how to pass this breakup entries? Yes? Okay. Remaining property, plant and equipment were valued at 60 lakhs. Means what? We have 72 lakhs. Out of 72, I gave 9 lakhs to someone. How much am I left with? I am left with 61 lakhs. Not 61 lakhs, sorry. 63 lakhs. This 63 lakhs, they are saying that you have to value it at 60. You have to bring down the value by how much? 3 lakhs. So 3 lakhs you have to reduce. Capital reduction account, 2 property, plant and equipment, 3 lakhs, 3 right? Then trade payable, trade receivable, inventories were valued at 15 lakhs, 13 lakhs, 9 lakh 44 respectively. Goodwill and profit and loss account are to be written off. So, first, trade payable, trade receivable, inventories were valued at 15, 13 and 944. Trade payables, they are saying 15 lakhs. How much do we have? 16 lakh 80,000. Means, what is the reduction? 1680 to 15 lakhs, 1 lakh 80,000 is the reduction. Means I have to debit trade payable by 1 lakh 80,000. Okay, so what will I do? I will debit trade payable by 1 lakh 80,000. Then trade receivable is now at 13 lakhs. How much do we have in trade receivable account? Trade receivable, we have 1375. Now they are saying trade receivable, you bring it down to 13. Means what? I have to reduce by 75,000. If I have to reduce by 75,000, I should debit or credit? I should credit the trade receivable. So, to trade receivable, 75,000. Same way to inventory, 36,000. And whatever is the difference, I am taking up to capital reduction account. That is, reduction in trade payable and reduction in other assets. Balance goes to capital reduction. Okay. Then they have said, goodwill and P&L debit balance are to be written off. What is the goodwill value? Goodwill value is 81,000. You have to write off. So debit capital reduction, credit goodwill, and P&L debit balance 1235 has to be written off. So goodwill 81,000, P&L 1235, capital reduction. If the question does not say write off goodwill, you will not write off goodwill. But debit balance in P&L, to the extent balance is available in capital reduction account, you will write off. So this goes to debit of capital reduction account, right? Then company paid 60,000 as penalty to avoid capital commitments of 12 lakhs. So they had some commitment, they had to pay some amount, penalty of 60. This you will debit capital reduction, which is a loss or penalty, to bank 60. So they have said interest on 10% debenture is paid every year on 31st March. We didn't see this information. Of course, in examination, we will see the full question first and then only come to the solution, right? So here, if some other date was given, that interest accrual would have made sense. 60,000 is loss. So that loss is 60,000 to bank. Okay. Now, all these entries, make sure you pass it to capital reduction and bank account simultaneously. For example, here capital reduction, this entry is done. This entry you have to pass. Bank account also prepare, because that will help you to calculate closing bank balance easily. You are required to pass journal entries, capital reduction and bank. The question has said capital reduction and bank. That's why we have passed it. If balance sheet is required, definitely capital reduction and bank is also required. So wherever bank is there, ensure you have posted it simultaneously. Bank to own debentures. This I'll come to it subsequently. Then debentures, debit to debentures, capital reduction debit. Wherever you see capital reduction, ensure you have passed the corresponding entries. Okay. So this is all what has happened. Now come to the balance sheet. Is there something left? Share capital done, equity share capital done, 8% done, this is done, this is done. Goodwill, PP is done, trade receivable, inventory is done, cash, we have prepared account. Own debentures nominal value of 6 lakh. Now here, own debentures nominal value of 6 lakh, even if nothing is mentioned, we generally assume that they will cancel out their own debentures. Now what they have done, they have sold this amount, 240 into 576 by 600, that part is sold. What is sold? The cost of debentures that is sold is 230,400. What is the total cost? Total cost is 576. So if I do 576 lakh, 5,76,000 minus 230,400, if I do the subtraction, so this is 600, 5, 7 minus 3, 4, 3. 345,600, this is the cost of debentures which is left out. This is the cost of debentures which is left out. This I will cancel. So if I have to cancel the debentures, I will credit own debentures. To own debentures 345,600. Then 10% debentures account at face value. How much is the face value? Out of 6 lakhs, 240 is sold. So 360 is the face value and the gain is 14,400. So this is how I will cancel the own debentures. Okay. Then once you prepare the capital reduction account, whatever is the balance left over after passing all these entries, that will be transferred to capital reserve. If nothing is left over, the account will close on its own. Otherwise, this will be transferred to capital reserve. Right? Now, if balance sheet was asked, how to handle? If balance sheet was asked in the same question, how to handle? If balance sheet was asked in share capital, we know there is a 40% reduction. So you will show it at the reduced value. Then preference shares, nothing has happened. Only the dividend has been given up. Preference shares will continue as it is. Debentures, out of this 18 lakhs, what did we do? There were debentures of 6 lakhs which we had bought back. Out of that, we cancelled, I think, worth 360. So 18 lakhs minus 6 lakhs we settled by giving machinery minus 360, that is debited. How to know? If at all you get confused, in the journal you can see 10% debentures 360 here and 10% debentures 6 lakhs here. So 360 and 6 lakhs is what we have to reduce. Okay. Then trade payables, there is a reduction. Goodwill, we have written off fully. Property, plant and equipment, here minus 9 lakhs which has been transferred and minus 3 lakhs which has been written off. Then trade receivable value is known, inventories value is known, cash at bank will come from cash account. Own debentures is no longer there, P&L debit balance also no longer there. Your balance sheet will automatically. Right? Almost all the questions are based on this structure only. There is nothing new which will be asked in the examination. Okay. In this specific question, is there any doubt, or after having seen this question the way we have solved, do you think you still have some more confusions in this capital reduction chapter? Can you please let me know, yes or no, in the chat box? And some of you may have this doubt as a narration is required, definitely required. If you don't write narration, about 2 marks you are losing. No need to write long, narration. Just write some simple one. Being in assets and liabilities revalued, something like that. Okay, so that is 2 marks for narration. Capital reduction account. So how they'll mark is, I'll just give you the breakup of this mark. So there are about 11 journal entries. Okay, about 10 marks here, about 3 marks here, and about 1 mark here. That is what will be tested. So now tell me, even if you misunderstand one particular adjustment, at least remaining journal entries you can write, you will score marks there. This also, out of 3 you will be able to score 2, and this may be 1. So very, very high scoring chapter, I would say. Okay, that's what you have to do. So if in own debentures sold come interest, if accrued interest is there, how do we treat it? So what happens is, if you sell it along with interest, so if for example it was sold at 98, assume 1 is interest component. Okay, 1 is interest component. So the amount that you will receive from the other party as one amount that you have received as interest, that will go off and knock off the interest component that was payable, right? But at your level, such complexities will not be tested. That complexity will not be tested. This one that you will receive, so you will receive basically in bank, you receive 98, your own debentures will be 97. To interest payable, you will add one more to the interest payable. Because it was your own debenture, you would not have added interest. Now that goes and gets added to the interest accrued portion. Okay. Now, here, next question. Earlier it used to be 20 marks, now it will be 14 marks only. So here you have share capital, reserves, long-term borrowings, trade payables, short-term borrowings, other current liabilities, short-term provisions, PPE, intangible asset, non-current investment, current assets, inventory, trade receivable, cash equivalents. Breakup is given, share capital, debit balance of profit and loss account 9.10. This has to be written off. 3200 10% debentures. Interest payable on debentures is given separately. Provision for taxation, land and machinery, furniture and fixture, patents and copyrights, investment, market value 1 lakh 10. This is 1.8. Okay, now let's see the adjustment. Each equity share is to be subdivided into 10 fully paid equity shares of 10 each. After subdivision, each shareholder shall surrender to the company 40% of his holding for the purpose of reissue to trade payables as necessary. Now here there is a share surrender. There is a share surrender. Now what is share surrender? Basically equity share capital. So first we will do equity share capital 100 to equity share capital 10. Do it this way only. Don't try to combine the entries. You will get confused. Then equity share capital 100, that is what is 16. Share surrender account 6.4. Sir, what is this share surrender account? Please note here we have not used capital reduction account because I am not cancelling the shares. I will hold these shares for subsequent issue to some other party. So we are not cancelling out the shares. So you will not use capital reduction. You will use share surrender. To equity share capital 9.6. Okay, so this is the reduction entry or surrender entry. Preference shareholders would give up 30% of their capital and 12% debentures shall be issued to them for the balance holdings. What does this mean? Here, preference shareholders would give up 30% of their capital. What is their capital? 8. 30% give up means 8 into 30%, 2.4 given up. Given up means reduced. Given up means reduced. And 12% debentures shall be issued to them for the balance holdings. So, entire 8 is gone. Entire 8 is gone. In place of that, what is happening is 2.4 is cancelled and 5.6 I will issue 12% debentures. So, preference share capital fully gone to capital reduction account, or you can say reconstruction account also. This is 100, 2.4 and 12% debentures 100, 5.6. This is a new liability. This is a new liability. When you prepare the balance sheet, you will add it to the right. Then the company would issue additional 12% debentures for rupees 4 lakhs for the purpose of meeting working capital requirement and final settlement of bank overdraft at 90% of the amount. Now there are two things. One, what they're saying we will issue for 4 lakhs for meeting its working capital requirement and final settlement of bank overdraft at 90%. What is bank overdraft value? Bank overdraft is 1.4. What they're saying is that 1.4 we will settle at 90%. So when we settle at 90%, we will pay only 14 into 9, that is 1.26. Only 1.26 will be paid. Only 90% will be paid. Balance 0.14 is a gain. 0.14 is a gain. And what is the value of debentures issued? 4 lakhs. So first bank account to 12% debentures 4 lakhs. This is the issue. Okay. Then bank overdraft 1.4 fully cancelled. So we will debit the bank overdraft account to bank paid 1.26 to capital reduction account 0.4. So what happens is, what you need to do is each adjustment you have to carefully break down what are they trying to say. Now some of you may have a doubt. Sir, can we say 4 lakhs for working capital and more amount for final settlement? No. They have directly said issued for 4 lakhs. So don't make extra assumptions. Alright. Then existing debenture holders would accept furniture and fixtures in full settlement. Existing debenture holders are where? They are at 3.2. 3.2 is going out fully. If 3.2 is going out fully, we will debit 10% debentures 3.2. What are we giving in turn for that? We are giving them furniture. Where is furniture? Furniture. How much? 2.8. Okay. So liability is going down by 3.2. Asset is going down by 2.8. I gave 2.8 worth of asset to settle a 3.2 worth of liability. Is there a gain or a loss? There is a gain. So what I'll do? Liability going down by 3.2. I will say debentures debit 3.2. Debentures debit 3.2. 2. Furniture and fixture. How much? 2.8. Balance is my gain to capital reduction or reconstruction account 0.4. Debentures 3.2. Oh, so see, missed it, no? Interest was also there. Sometimes, we tend to miss. Debenture holders would accept in full settlement of their dues. While reading the question, we saw there is interest payable also 0.32. So 3.2, 0.32. For that we are using 2.8 of settlement. So what you can do, if you don't want to pass this entry, you can directly say 10% debentures, interest payable 3.2, 0.32, 2 furniture and fixture 2.8 because furniture is going out, 2 capital reduction or reconstruction account, the gain 0.72, that is basically 0.4 on principal and 0.32 on interest. This is how you can pass the entry. Or you can say 10% debentures interest payable to debenture holders, then debenture holders to furniture fixtures to reconstruction. All right. So this thing. Now, how to avoid missing these kind or making these kind of mistakes? Once you are done with passing the entries, please run through the entire balance sheet once, so that you get to know if you have missed out something. Trade payables claim shall be reduced to 70%. In the previous case we saw buy, now we are seeing to 70%. It is to be settled by issue of equity shares of rupees 10 each out of share surrender. So what they are saying is trade payables claim shall be reduced to 70%. How much is trade payable? Trade payable in the balance sheet is 1.15. Okay, this has to be reduced to 70%. Means 1.15 you are settling only 70%. So trade payables 1.15, trade payables 1.15, %. So 70% of that is 1.15 into 70%, 0.805. I'll do it again. 1.15 into 70%, 0.805. Out of 1.15, we have to give, we are settling it at 0.805. Now this 0.805 is being settled using the share surrender account. We are settling this 0.805 by using the share surrender account. Right now, trade payable total balance is 1.15. Trade payable 1.15. We are cancelling out, so we will say trade payable debit 1.15. Then we have to give them shares out of share surrender account to the extent of how much? To the extent of 0.805. Are we paying any cash to them? Are we paying any cash to them? We are not paying any cash to them. We are only using the share surrender account to issue them equity share capital. We are only using share surrender account to issue them equity share capital. We are not paying any money. We are not incurring any further losses. We took some shares from the equity shareholders account and now we are directly giving them to the trade payables account. So when you are giving it to the trade payable account, what you can say? Trade payable account debit. I cannot say to equity share capital because I am not raising a fresh share. I am not raising a fresh share. So this entire 0.805 whatever is being settled is settled using my existing shares. In other words, can I say my liability towards trade payable has been extinguished? Can I say the entire liability? First 30% is written off and balance 70% is also through shares surrender account. So entire trade payable has been cancelled and I have a gain of 1.15 which I have transferred to the reconstruction account. Right now, how do I settle this? What I'll do is using the share surrender account, I will use 0.805 to bring it back to the equity share capital. So share surrender to equity share capital account 0.805, this number. Balance, the question, what the question has said, the share surrendered and not reissued shall be cancelled. So The balance will be cancelled and credited to reconstruction account 5.595. Once again, this is a typical adjustment. We have trade payables of 1.15. This 1.15 I am paying by using shares surrendered. How much? 70%. 30% anyways is cancelled. 30% anyways is cancelled. If it was a fresh share issue, what I would have done? I would have said trade payable 1.15 to equity share capital 0.805 to capital reduction the balance amount. But here I am not issuing fresh shares. I am using share surrender account. Now can I again credit share surrender account? I cannot credit, right? Because I am not getting shares from anywhere. I am not getting shares. I am not getting it back from somewhere else. So I cannot credit here. Basically what I am doing is the share surrender account that is there, I am using that to settle the trade payable. So what would happen? This trade payable fully will go off, and in place of this, equity share capital of 0.805 will come from the share surrender account. So that is why the full value of trade payable is as good as cancelled, because I am not paying. Think of it, if I had issued a debenture, if I had made the payment, if I had agreed to continue the liability, then it would have been a different case. Here, I am not paying anything afresh. I am using the existing share surrender account to settle the liability. So, share surrender account 6.4, equity share capital 0.805 to reconstruction account 5.595. Alright, then the taxation liability is to be settled at 50,000. 50,000, how much is the liability? Liability is 42,000. I had to pay 42. Now I am paying 50. Means I will say to bank 50. But I only have how much? 0.42. Provision for taxation 0.42. To bank 50. I had to pay 8,000 extra. 8,000 is my loss. So capital reduction or reconstruction account 0.08. 0.4 to 0.08 to 0.50. This is 2. You can directly write this as 2 back. Then investment value to be reduced to market price. What is the value? Market price is 110, actual price is 1.8. So 1.8 is the value. I have to bring it down to 1 point, means 0.7 of loss. So debit reconstruction 0.7 to investment 0.7. I am reducing the value of investment 0.7, 0.7. Balance of P&L to be written off. This will do it towards the last. Value of inventories is to be increased by 32. Increase by 32 means asset increase, gain. So inventory, debit, gain. Then provision for doubtful debt is to be created at 5% of trade receivable. This is a new provision created. Do we have any provision in the balance sheet? If you come to trade receivable, they have not given us any information. So trade receivable 4.32 into 5% will create. So 5% of this will be 4.32 into 5% will be 0.216. We have to create a provision. To create a provision means to provision for bad debt. We are creating a liability or we are reducing the value of the asset. So this will be credited 0.216. Provision for doubtful debt 0.216. Inventory account debited 0.32. Increase in the value of inventory to reconstruction account 0.104. Now sometimes some of you may face that, sir, but to pass combined entries we find it difficult. You can pass separately. Inventory to reconstruction separately, then reconstruction to provision for doubtful debt separately. That is also possible. But if they are given 4 or 5 items together, increase in asset, debit, decrease in liability, debit, decrease in asset, credit, increase in liability, credit, and balancing figure to reconstruction account, that can also be done. Then the profit and loss account balance to be written off 9.1. Whatever is the leftover balance, capital reserve will be transferred to 0.229. So what you can do is, here they have not prepared, but I strongly suggest to prepare capital reduction account, because lot of time while doing totaling in this journal entries, we may miss out. We may make mistakes. After doing so much of effort, if we do a calculation mistake and lose marks, it is not worth it. So it will not take much time. Prepare capital reduction account properly, and bank account you can do because only 2 or 3 entries would be there. Balance you will, you can do it from that. Now, how to handle the balance sheet? Again, share capital, there are changes. So what are the changes? One, there is cancellation of shares. So that is the reduction. Then there are shares which have been issued. Okay, so that has to be returned. Reserves and surplus, this 9.1 has been written off, but capital reserve will come. Then long-term borrowings, debentures, existing debentures settled, new debentures have come. So like that, you can present it. Issued capital, conversion of equity without payment being received in cash. All shares are allotted as fully paid up pursuant to capital reduction scheme. So that you can write a note of that. Then capital reserve, whatever balance we got. Unsecured loan 12%. So we have 2 breakups. Plant and machinery 5. I don't think there is any change in plant and machinery. Plant and machinery 5. Furniture and fixture 2.8 has been taken over, right? So you have to note from that. Then intangible assets, patents and copyrights. Don't write off unless the question asks you. Okay. Losses you can write off. This you should not write off. Investments, we have brought it down to the book value. Inventory, appreciation is there. Trade receivable, provision is there. Okay. So with these notes and the balance sheet, will be able to do. Any doubt here? Any doubt? Goodwill, the question has said, no? Here there is no goodwill. The breakup, if you see, it is only patents and copyright. Goodwill also, only when it is said, only then you will write off. We cannot assume that goodwill is worthless. Okay, the question will mention specifically. In the previous question, if you see, goodwill and P&L account are to be written off. P&L you will write off because P&L is fictitious. P&L is fictitious, you will write off. Goodwill, patents and all, we believe they have some value. Unless the question mentions, we will not write it off. Any preliminary expenses shown in the debit side, okay, any fictitious asset, what I am saying is, any fictitious asset you will write off. Okay. Otherwise, you have to see the question what they have mentioned. Now, see, almost all the questions will be in the same pattern. So we will see some adjustments, a couple of more adjustments, so that we have more clarity. Okay. Here, preference shares are converted from 6% to 8%, but revalued in a manner in which the total return of them remains unaffected. Now, what does that mean? Here, if you see, you have 6% shares of 6 lakhs. 6% share of 6 lakhs. What they're saying is, from 6%, we'll make it 8%, so that the total return remains unaffected. Means, on 6 lakhs, how much is the return into 6%? That is, the return is 36,000. Return is 30. Now what they're saying is, this 36,000, they should earn 36,000, but at 8%. How much should they get? They should get 36,000 divided by 8%, that is 4,50,000. Or what you can say, what you can do in case you are confused, what you can do is, you can say return, 36,000 return is needed and we need 8%. So 8% of preference share capital should be equal to 36,000. If 8% of preference share capital is 36,000, preference share capital is 36,000 divided by 0.08, which is 4,50,000. So, new preference share capital is 4,50,000, balance amount goes to capital reduction. Okay, then value of equity share is to be brought down to 8 per share. What is the value? 10. From 10 you will bring down to 8. Arrears of dividend and preference shares are to be cancelled. Is there any arrear given in the balance sheet? They have not given, so there will be no entry for that. Okay, because see, if dividend payable is there in the balance sheet, then we can cancel and then there will be a gain. But if dividend payable is not there in the balance sheet, there is no point in cancellation. Debit balance of goodwill account is written off entirely. So whatever is there in the goodwill, I think 1,20,600 entire value, right? No, sorry, 84,636. Only goodwill has to be written off. Book debts amounting to 14,400 are to be treated as bad and hence written off. Reduction in value of your receivable, hence a loss. Company expects to earn profit at the rate of 90,000 per annum from the current year, which would be utilized entirely for reducing the debit balance in P&L account for 3 years. The remaining balance of the said account would be written off at the time of capital reduction. So they are saying 90,000 for 3 years. Now, what do we have? Balance is 3 lakhs. Out of this, we will earn 90,000 into 3 for the next 3 years. That is 2,70,000. So balance 30,000 has to be written off. So what we'll do, we'll write off balance 30,000 in the P&L. The balance of total capital reduction is to be utilized to write down the patents. Now here they have said specifically balance left over, you will write down the patents. So for that, you will prepare a capital reduction account, and whatever is the balancing figure, you will not transfer it to capital reserve, but you will use that to write off the patents, which is 24,000. So that is done. Secured loan of 4,80,000 bearing interest at 12% is to be obtained by mortgaging tangible fixed asset for repayment of bank overdraft and for providing additional funds. What does this mean? 480, we will raise new loans and we will use that loan to pay off overdraft. How much is overdraft? 2 lakhs. 2 lakhs. Bank overdraft 2 lakhs has been paid off. Then you can prepare the balance sheet. Now while preparing balance sheet, again line by line, changes in share capital, write it. Reserves in surplus, this will now be 2,70,000. Short-term borrowings has been paid off. Trade pay. Now here actually they have not told that overdraft is short-term borrowing. We have assumed it because there is no other information available. We have assumed that. Okay, same way goodwill is written off fully. Then patents, we have brought it down. So like this, if we do step by step adjustment, we will be able to solve the question. And even if, I'm again telling you once again, even if you leave out one question, you miss out one question, don't worry about that. You will be able to score good marks out of it. Okay, it's a very simple question, 5 marks. That's okay. So now this question, the only thing to solve it in the examination is be patient, have a lot of patience. Okay, and because you are patient, you have a lot of patience. What you can do is read the adjustment properly. To buy, see, we'll make mistakes only in calculations. They would say 5%, earlier it was 12% debentures, now we are making it 10%, same earnings, what we saw in preference share case. Okay, then they would say, we'll write it down to, write it down by, this asset has been taken over by this person, this liability, that could be one scenario. Investments to be brought to the market value, that could be one scenario. Right. Apart from that, there is no other critical adjustment that you need to do. Practice 2 to 3 questions before the examination. That is more than sufficient. All right.